instance, I actually had a day just yesterday where I traded in the morning and I made some money, and then a stock made a huge move later in the day. And some people were like, Ross, I can't believe you didn't trade that. And that can lead initially to the feeling of FOMO and frustration, disappointment. I coulda, woulda, shoulda. And I said, no, wait a second. I walked away when I did yesterday because it was at a time of day where I should have already made a lot more progress than I had. I had not yet hit my daily goal. I had made some profit and I gave some back. I felt like the market was choppy. I didn't feel like I had a good read on it. And I said, you know what? It's better to walk away right now with some profit in my pocket, real money in my pocket, rather than give it back. Because I know statistically, if I keep trading, when I don't have a cushion, I'm going to make a mistake and I'm going to go red. So it's always better to have a small green day than to go red. So my decision in that moment was the right decision. Now, as it turns out, had I kept trading, is it possible that I could have made a lot of money trading that stock that goes up? It's possible, but hindsight is always going to be biased to favor that you would have done well. And the reality is sometimes you would have actually kept trading and lost money. Anyways, quantify or qualify trades as being good or bad based on the decision that you made at the time, not the outcome of the trade. Okay, so with those micro pullbacks, I can do extremely well. And sometimes this first candle opens and the next candle, sometimes it's like, it's almost like this. It opens just a teeny bit lower and then pushes higher. But I'm okay with taking this micro pullback, especially when this is around a whole dollar or a half dollar level of resistance, because I know that these are levels where once the stock breaks over it, I can use that level to base my my support. Okay, so we've spent a fair amount of time talking about candlestick patterns, which is good. I want you to have a really good understanding of this because ultimately, while technical indicators are valuable, they cannot be a substitute for candlestick chart patterns. Candlestick patterns are where all the information comes from that gets populated into the technical indicators. All right, but technical indicators are worth mentioning. So let's get on the whiteboard here, and let's talk about some of my favorite technical indicators. Okay, so when we're looking at a chart pattern, what I've shown you so far is the pattern of this as the price moves up. So long body candlestick, light pullback, maybe here we get a doji, and then we get another move back up. But there's something that I have left out that is extremely important in helping me predict whether the price is going to continue higher or it's going to decline. And that is an indicator that we're going to put right down here underneath the price. And it is volume. So we usually have a volume bar down here at the bottom. And what I like to see is increasing volume as the price is moving up, lighter volume on the pullback, even higher volume as the price goes higher, lighter volume on the pullback, and higher volume as it continues higher. I don't actually draw trend lines on the volume, but I'd like to see the volume is generally increasing. This tells me more and more traders are interested in buying this stock. Now the next indicator uses volume and price together to create the volume weighted average price. It's the volume weighted average price. It is actually factoring in the price of the stock and the amount of shares that traded to give you an average price. This is a really important gut check. The stock should always be priced well above VWAP when it's trending higher. It's very common that when we see a pullback, we see a sharp pullback, we'll see the price bounce off the VWAP. VWAP is almost always a significant area of support when the price is above it, so we'll see a bounce, and sometimes we'll end up seeing a move all the way back up. But if the price goes below and breaks below VWAP, it usually will have a hard time getting back up above it because this is now resistance. Okay, now the next indicator that I'm going to draw here, I'll draw it in this line, this color here, brown. This is called a moving average. So the moving averages, the thing with these indicators is that they're telling us the average price of the stock over a set period of time. So I use the 9 and I use the 20. That's confusing to draw it that way. It makes it look like it's divided. I use the 9 exponential moving average, and I also use the 20 exponential moving average. The 9 will always be faster than the 20 because the average price of the last 9 candlesticks, 1, 2, 3, 4, 5, 6, 7, 8, 9, is going to be a higher average price than the average price of the last 20 candlesticks. It's going to be a lower price. However, the reason I use this is because when we have a trending stock that's moving higher, these moving averages, they help kind of show, they help us understand how extended the stock is. When it starts to get really, really extended, the risk is higher because those moving averages are a moving level of support. And this again comes back to the fact that we know when we buy closer to support, we've got a better entry that allows us to manage risk, and that can mean we're more profitable. So I use moving averages as levels of support. I look for the stock to return around the 9 moving average, and when we're looking at these patterns, one of the things that you'll notice is you'll watch these stocks, and it's like, you know, they just sort of, they move up all day long, and the stock goes up and then down, 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 and the whole time it's like just bouncing off the 9 exponential moving average. And when it finally pulls back a little bit more, it's coming down to the 20 EMA. So these are two very well